Hello, my name is Melissa Golding, and I'm the press officer for the Group of 30. I'd like to welcome all of you to today's live press conference and webinar launch of the G30's new research report, The Past and Future of Money, New Technologies and Economic Risks. We will begin the webinar with opening remarks from the chair of the Group of 30's Working Group on the Future of Money, Dr. Kenneth Rogoff. Dr. Rogoff will be followed by Project Director Max Harris. After Mr. Harris makes his remarks, he will be joined by Dr. Rogoff for audience Q&A. Please note that this report and presentation represent the views and recommendations of the Group of 30's Working Group on the Future of Money, and not the Group of 30 as a whole. While the report reflects broad agreement among the working group's participants, this does not imply agreement on every specific observation or nuance. Working group members and the project director participated in their personal capacities, and their participation does not imply the support or agreement of their respective public or private institutions. I'd now like to introduce Kenneth Rogoff, Chair of the G30 Working Group on the Future of Money. Dr. Rogoff?
Thank you very much, Melissa. Thank you to everyone who's here. You have before you the working group, which included a number of members of the G30, including current and past heads of central banks from Europe to China, UK, and Melissa gave a very careful statement, which I will repeat, which is, this is the view of the working group, and this is a complicated problem with many subtleties and nuances. And so even within the working group, much less the G30, there are a variety of views, although I think what the report states represents something of a broad consensus. Obviously, this is a very fast-moving area. There's a lot of exciting, innovative ideas, and we tried to approach this and thinking about where we would like to see things land. And, sort of one general statement I'd make, and this applies probably to many other things, is that from the point of view of regulators, I'm not a regulator, I'm an economist, central bankers, but also economists, sort of an ideal, scenario would be one in which the the regulator told the tech community what they're looking for, what money is, what they would like it to accomplish, where it's acting like a debit card or a credit card, what are certain restrictions and properties we'd like it to have, where it's acting in lieu of cash, a digital cash, what are properties we'd like it to have. And I think, the way that this has evolved is really the opposite, with where the tech community has developed these very clever ideas and sort of presented it fait accompli to the policy community. And there's certainly a tension there, and you'll see that reflected in this report. So, for example, we are not, this is representing the whole world, not just the United States. We are of the view that central bank digital currencies are still a very important part of this mix and shouldn't be shut down just because they might compete with private stablecoins. And if I could sort of, cut through a lot of where the report goes, we see the Genius Act in the United States as really trying to recreate this pre-Civil War banking system. And I know there are those that would say it was the post-Civil War, but we don't think that's right, where there were lots of bankruptcies, lots of problems that eventually led to something. And I think that will be the case here. For example, I think there's a strong argument to be made that in the long run, a couple stable coins two or three will dominate. There are network effects. There's all kinds of things. Yet, I think politically, it was very difficult for Congress to say, we're going to select the two current winners, we're going to anoint them. The same reasons that we have trouble with the CBDC. We don't want to shut down innovation. So perhaps, at the end of the day, this will lead to something that's stable, but we envision a long period with a lot of bankruptcies, bailouts, analogous to what we saw in the pre-Civil War period. Max will talk about that at length. Yeah, I mean, it's true that there are guardrails and such, but they are pretty thin in many ways. So that's certainly a major concern about financial stability. I mean, there are broader questions of where you would like the global financial system to land. Certainly, one does not want to stand in the way of innovation. There's a question, though, and we raised that in the report, as to what extent can the existing so-called two-tier system, which has the central bank as the final single money and everything else below that references it, to what extent can that system adopt some of the changes, perhaps egged on by the competition in these changes? To what extent can it adopt them and faster settlements, better international settlements, while still maintaining the important checks and balance we have, such as know your customer, anti-money laundering laws. And I think the group of 30s had in mind the whole time that we don't want to advantage the incumbents when we're looking for regulation of new technologies. We're looking at the economics of it. What's something that's parallel? We don't want to bring the same regulation to a different type of financial instrument. And at the same time, I think it's very important to look ahead to where the government's going to stand behind these currencies, these different payments mechanisms, which, as you well know, happens indirectly, even when we say it's not going to happen directly. Uh, you know, I don't need to tell this audience how that happened in the global financial crisis and again in the pandemic. So another issue which has sort of been swept under the rug, I would say there's been quite a bit of discussion about um, there could be crises, there could be problems, which maybe is by design of the whole system needs to have the market pick the winners and losers, no matter how painful to get to the other end. Uh, we think one could do better. But I think it's very important to recognize that stablecoins are not just replacing cash, they're replacing a broad variety of financial instruments. And if you look at the way the Genius Act in the United States is designed, it really asks the question, how can we make the regulations like cash? Well, when I go to the bank, they know me. They know when I took out $4,000, that'll actually get reported, that'll get registered. But once I start handing out the money, they can't trace it. And you can do a little better with stablecoins with current technology, but I think it's really exaggerated how easy that is to do, or even how soon we'll be able to do it easily. We see that with Bitcoin. It can be done, but at great expense. And so, one of the questions that arises is the Treasury argues that we'll get lower interest rates because we're raising the demand for Treasury bills. But I think just as if we issued $1,000 notes or $10,000 notes, that would raise money for the Treasury. But you'd have to ask, what's the cost? How much more tax evasion, crime, illicit activity, regulatory evasion would occur? Those are very big numbers. And if you multiply them by 10% or 15% annually, I would say you would more than pay for any gain you got from the Treasury bills. And part of the reason stablecoins are thought to crush CBDCs is precisely because CBDCs, central bank digital currencies, excuse me, worry about this problem. And stablecoins have not, but the regulators could. require that? I think that's an important question. And then, finally on central bank digital currencies, Max will talk more about this. I think other countries are going to plow ahead with this. There, when you start thinking about the end game of stable coins and not the mad rush to be on top, we're probably just, I'm conjecturing, going to have a few. And then the regulation, the issues, the know your customers, anti-money laundering laws start to look awfully parallel to what bothers everybody about central bank digital currencies. The reason the public doesn't like them is they don't want any code embedded. They don't want any backdoor. They don't want any restrictions. Well, that's fine. That is what the demand is. There's huge use of cryptocurrencies in the underground economy, as I write about extensively in my book. But that doesn't necessarily tell us where we want to land. So it's very hard to keep up with this very fast evolving uh, space. But just to summarize, we think it's important to ask, what is the economics? What are we trying to accomplish? What is this trying to replace? And not simply, where is a path for regulatory evasion that makes a lot of money in the short term, but might be disruptive to the global economy in the long term. And I should say, lastly, I mean, certainly there are all sorts of other things coming out of this tokenization of assets, which, by the way, has some of the same problems about traceability, auditability. But I think, by and large, this will be a big boon to the financial sector. Certainly, many other innovations. Stablecoins has so far been the killer app of cryptocurrencies. And yet, in the end, I think we have to ask, where is this landing us? Who's in control of what's going on? What risks are being taken on the taxpayers' behalf in the name of moving this ahead as quickly as possible? Thank you. So I should say I'm turning it over to Max, who's the project director, and he will talk much more about the paper itself.
Thanks so much. I guess before I begin my remarks, I'd first like to thank Ken for chairing this project, all of the working group members in the G30 team. It was a real pleasure collaborating with everyone on this report, and I think we were able to cover a lot of important ground in this fast-moving space. Um, so because the report covers so much ground, I'm not going to try to summarize it all during my brief remarks today. Rather, I'd like to zoom in on three of our key points. So first is the framework we use when thinking about the future of money. To date, much of the discussion tends to focus on the technology, this new coin or that new blockchain. This is, of course, important, but all the talk about different protocols can obscure the fundamental issue, how to make money safe and trusted. And this is a question of economics and finance, and it's also a question that societies have dealt with throughout history. So we think it's important to recenter the conversation on the economics and finance and to keep the past in mind when we're considering the future. And when we do this, we see that, actually monetary systems have been unstable for much of history. And it's only in the recent era that countries have found a sturdy foundation with the two-tier system that Ken was discussing, where public money issued by central banks and private money issued by regulated commercial banks coexist. And so when we're considering new technologies, we need to see how they fit in this structure, or how they extend it, or where they might put it at risk. And with this broader perspective, we can better understand the opportunities and risks posed by innovations in payments and money. And of course, the new technology that's gotten the most attention is cryptocurrencies. We think most cryptocurrencies like Bitcoin are very volatile and don't have a place as money in the conventional financial system. But stablecoins, which are structured to remain stable against an underlying currency, overwhelmingly the dollar thus far, are much more like money, and I'll talk about them quite a bit today. So they bring the potential for faster, cheaper, and smarter payments. Yet for all the excitement behind stablecoins right now, there is an underweighting of the risks they pose to financial stability and integrity. This isn't to say that stablecoins have no place, but if they are to become mainstream, it's imperative that regulation be in step with all the risks. And then the final point that I'll discuss today is that, stablecoins aren't the only possible form of digital money for the digital age. Central bank digital currencies have received a lot of attention, and we think it's important for central banks to ramp up work in this area, as CBDCs could provide much of the novel functionality while doing so from the foundation of the two-tier structure. So, okay, the first thing to understand about money is it's not stagnant. So there have been transformations in money throughout history. You could go back to precious commodities like gold and silver, to paper currencies that are backed by precious commodities like gold and silver, to fiat paper currencies. We've also seen a shift from money being, physical objects to, entries and ledgers. And now we're on the verge of another such transformation with the spread of distributed ledger and other technologies. Blockchains make it possible to send value across the world that settles nearly instantaneously. They make access to digital wallets open to anybody with a smartphone. They allow for the tokenization of money so that money can become programmable. All of this means that these technologies bring the potential, but I should stress by no means the guarantee, for faster, cheaper, and smarter payments. And this technology and potential have caused a lot of excitement. But by focusing too much on what the technology can do rather than what money should do, we risk opening the gates, ending up not with better money, but worse money, unsafe money, and distrust in money. And the final point here is that it's important to note that what route we take for the future of money, it doesn't just affect, legacy banks or fintechs or stablecoin issuers or crypto firms or central banks. It affects everyone. A stable monetary system is a precondition for a healthy economy, and so the stakes couldn't be higher. And we think the historical context helps illustrate these points. So, I really encourage you to read the entire report, of course, but I especially encourage you to read section 3 on money through history, because we think this context is really key to understand the situation we're in today. And the main takeaway from that history is that for much of history, monetary systems were extremely chaotic. So when gold and silver were money, you might think it was some idyllic system where everything was great. It wasn't. It was a mess. There were all sorts of different current coins that were circulating of different qualities that made transactions very complicated. Once banks started issuing paper currencies, the same problem could arise. Banknotes might have the same face value, but people valued them differently. And then later in the evolution of money, in the second half of the 19th century, bank deposits took off. But here there would be repeated panics when holders questioned the bank's ability to redeem the deposit in legal tender. So in short, the problem for centuries was that different forms of money were not interchangeable one-to-one at all times, and they often traded at varying exchange rates relative to one another. This could cause transactional frictions, it could impair trust, and it hobbled commerce. This multiplicity of money was a general problem, but it really reached its apex in antebellum America during the free banking era that Ken mentioned in the mid-19th century. So the country had thousands of banks issuing their own notes that circulated as money. But the banks were poorly regulated, and so some banks were more reputable than others, and their notes were accepted as closer to face value than those from other banks. So, a $10 note might be accepted at $10 if it's from one bank, or maybe $9 or $5, or it might just not even be accepted. And these discounts on the face value, they varied both across time and space. Um, so it was a very kind of disordered system, and to operate in this kind of chaotic system, merchants would rely on large books known as banknote reporters, which listed every bank and the prevailing discount on their notes. And so this picture on the slide shows an excerpt from one such reporter, and it basically is just listing all the banks from Maine and the discounts that were then prevailing in the note market as it existed that they suggested merchants should take when accepting, a dollar from the agricultural bank of Brewer versus some other bank. And so we discussed in the report that this system was, uh, widely reviled at the time. So, workers often had no choice but to accept bad banknotes in payment. Merchants would complain about the profusion of notes they had to deal with. And eventually, it would actually take the Civil War for the US to reform its monetary system through the creation of the national banking system, which provided a uniform currency, as we discuss in the report. So, more generally, in the ensuing decades, there was a movement toward what's known as the two-tier system that we have today, which allows for multiple forms of money, but ensures that each is accepted at par. So, at the base of the two-tier system is the central bank, which issues public money in the form of cash and reserves. Commercial banks then issue money in the form of deposits. And critically, the different forms of money are tied together and convertible into each other. The central bank processes interbank payments through movements in reserves. A person can withdraw money from their deposit account in the form of central bank notes. And then the central bank ensures trust in the value of money by controlling inflation, which of course underscores why central bank independence is essential. This two-tier system has many benefits, and one of the most important that we really highlight in the report is the singleness of money in payments. So unlike so much of the history I just described, today we treat a dollar as a dollar or a pound as a pound. There's no, Bank of America dollar that differs from a Citibank dollar that differs from a Fed dollar. Money's always accepted at its nominal value, and this is key to support trust in the system. Now, most consumers and businesses take this singleness for granted because it's so ingrained in how we interact with the monetary system. But as the historical discussion showed, it's not guaranteed by any means. And in fact, it depends on an intricate regulatory, supervisory, and legal architecture built over decades that includes everything from deposit insurance to lender of last resort facilities and the regulatory requirements we impose on banks. The last point here is that it's important to note that while the two-tier structure provides a sturdy foundation, the monetary system today is, of course, not perfect. So to begin, some countries don't have a functioning two-tier system because there's rampant inflation and agents don't trust the domestic currency. But even where the two-tier system is alive and well, the broader payment system has shortcomings. Payments can take too long and they can cost quite a lot. When we live in the digital age, when everything else we do happens in an instant, you start to wonder, why does it take days for payments to settle sometimes? And then current monetary instruments, cash, reserves, and deposits may potentially lack the functionality such as programmability that could be useful in today's world and perhaps even more so in the future. So all of this brings us to crypto and stablecoins. Crypto offers a different means of organizing a financial system, one that uses blockchains and ostensibly operates through decentralization instead of relying on financial intermediaries. I say ostensibly because, as I'll discuss in a little bit, much of crypto has actually become quite centralized. So Bitcoin was the first cryptocurrency. The white paper was from 2008. I think the first Bitcoins were in 2009. And today it has a market cap of about $2.5 trillion. So it accounts for roughly 60% of the crypto space. It's still the big player. But for reasons that we discuss in the report, Bitcoin and other unbacked cryptocurrencies that aren't tied and redeemable in another asset are so volatile that they don't come close to satisfying the necessary properties to be good money. In addition, there are concerns with how blockchains, particularly the Bitcoin blockchain, work, such as the amount of energy consumed to validate transactions that also push against, some future where Bitcoin is really foundational to the monetary system. But what Bitcoin did do is it unleashed a new era in how we think about money and payments. And one outgrowth has been stablecoins. These are cryptocurrencies that are designed to maintain a stable value against a fiat currency, almost always the US dollar. And because of this stable value, they, become closer to satisfying the properties of money. And the figure below shows how stablecoins work. So, as we'll see, while the original idea with cryptocurrencies was to create a decentralized financial system, stablecoins are very much not decentralized. So, you have a stablecoin issuer, which is in the green box, which will mint new coins in exchange for dollars at a 1-to-1 ratio. It then invests these dollars, generally, but not always, in cash and cash-like instruments, earning the interest on the reserve assets. This business can be quite profitable, as evidenced by the success of Tether and Circle, which are the two largest issuers by far. And actually, they've become so big that these issuers are now serious players in the short-term treasury markets, because they invest so much of their reserves in treasuries. Another thing to note about how stablecoins work is the issuer generally mints and burns coins only for institutional customers in the primary market. Everybody else who wants to hold stablecoins purchases them in the secondary market, often on centralized exchanges, and does so at the prevailing market rate. So this rate on the secondary market can, and in the past has, diverged from par, from that $1 per coin value, sometimes quite significantly, and probably most famously during the run on Silicon Valley Bank in March 2023, when Circle's USDC fell to 87 cents. And it's this varying market rate that can impair the singleness of money. So with that background, now we can turn to the potential use cases for stablecoins. Stablecoins actually started out as just a way to facilitate risky trades within the crypto ecosystem, but they now seem on the verge of extending into the traditional financial sector. So stablecoin growth has been absolutely remarkable. Its market cap of all the stablecoins has increased roughly 60-fold over the past 5 years, from $5 billion to $300 billion today. As with other cryptocurrencies, stablecoins exist on the blockchain. They can transfer value nearly instantaneously. And as on-chain tokens, they have the potential for functionality that existing forms of money don't. So code can be included in the token, for instance, that can make transactions go through only if preset conditions are met. So you can have conditional payments automatically programmed in. And there are many potential use cases for stablecoins. So payments could become faster and cheaper, perhaps domestically, but with much more likelihood internationally, where cross-border payments are notoriously slow and expensive. This could make remittances less expensive, as well as reduce companies' working capital needs. Programmability, as I just mentioned, could allow for smart contracts that could change how payments are made, for instance, enabling atomic settlement for trades in financial assets. Stablecoins are also very easy to access. Anybody with a smartphone can, which has the potential to increase financial inclusion. And one of the biggest use cases to date is actually, not in the United States, but outside the United States, where households and businesses seeking access to dollar instruments, often because the domestic currency is unstable, purchase stablecoins and try to find some refuge from the monetary problems at home. So for all these reasons and more, stablecoins are very intriguing. But any assessment must look, not only at the opportunities, but also the risks. And there are quite a lot of risks. So this slide lists many, but not all such risks. And I'll just kind of run through them pretty quickly. So first, if stablecoins take off and become widespread, they could threaten financial stability. The most basic issue here is the potential for runs. So the whole stablecoin promise is that one stablecoin equals $1. But unless reserves are parked entirely at the central bank, issuers might be unable to fulfill this promise in the event of a run. And a run on one stablecoin could spark a run on others, which could lead to fire sales of reserve assets, broader financial stress, and serious problems in the payment system. Even in the absence of runs, stablecoins could impair the singleness of money that I discussed. As mentioned, they don't necessarily trade at par. They often trade very close to par, but they've also traded at steep discounts or even at times premium. And once money doesn't trade at par, individuals and businesses need time need to invest time assessing the quality of payment media, which can cause doubts to creep in about the value of money and harm trust in the monetary system. So, this is in many ways reminiscent of the banknotes in antebellum America, though, as we make clear in the report, we understand, with real-time markets and greater transparency, stablecoins would presumably trade much closer to par in general than those notes did 200 years ago. Stablecoins could also disintermediate banks as depositors move their funds out of banks and into stablecoins, which could then reduce credit to the economy. Another risk is a fear outside of the United States, which is the potential for dollar stablecoin use to erode monetary sovereignty. If individuals use dollar-based stablecoins as a store of value and to transact in foreign countries, central banks could have a harder time influencing monetary policy. And then lastly, but definitely not least, crypto is the preferred medium of exchange for illicit finance, and stablecoins are becoming the preferred type of crypto for such illicit activities. The pseudonymous nature of the blockchain, coupled with different methods to disguise the origin of coins such as mixers, make crypto quite attractive in this regard. And this is a massive issue because it can facilitate everything from sanctions evasion to terrorism financing to money laundering and tax evasion. So kind of the key point from this slide is, the technology is very interesting, but we can't just be awed by the new technology and ignore the very serious risks that are involved. So how can we, try to make stablecoins safer? I mean, this is a question if it turns out that they offer this, foundational innovation that's really going to take off. Because, we should kind of remember where we are. There's been a lot of excitement about stablecoins, and they have grown remarkably in the past 5 years. But within the broader payment space, $300 billion isn't that big yet. But if the market grows into the trillions and we haven't sorted through these risks, we might be playing with fire, right? So the past few years have seen the first attempts to regulate stablecoins, most notably the U.S. Genius Act that became law this summer. The Genius Act does some good, such as requiring reserves to be in high-quality liquid assets. And it'll be really important to see how the rule writing process over the next year goes to see how the act is actually operationalized. But we think that, we can already tell some areas where the act falls short. So I'll just briefly discuss a few of them. So one question is the payment of interest on stablecoins. Stablecoins are intended to be payment instruments, and so we think they shouldn't pay interest because it's not an investment. And the Genius Act actually prohibits issuers from paying interest, but it does not prohibit affiliates or other entities from doing so. And so there's this loophole that effectively allows stablecoins to pay interest. And this could, this has issues because it could not only cause issuers to try to invest in riskier and more illiquid assets, but it could also exacerbate any disintermediation of banks because if it's paying interest, it's going to be, more attractive potentially. The act also does a little on anti-money laundering. So it does make issuers subject to the Bank Secrecy Act, but the big issue is that once a stablecoin is on the blockchain, there's little insight into who is using it for what purpose, providing plenty of opportunity for nefarious actors. So dealing with this problem is not easy. It could potentially involve embedding code to try to make tracing coins more possible, but it's essential if stablecoins are to go mainstream. And then the third issue I'll touch on is the issue of runs and the potential need for a lender of last resort. So if stablecoins ever do become systemic, the question is going to come up whether the central bank should serve as a lender of last resort. We don't think central banks need to declare such a policy today. Is there still time to see how stablecoin usage develops? But if stablecoins really become the money of the future, this is a problem that central banks are going to have to deal with. And it's not a decision to be taken lightly. You just don't just hand access to, lender of last resort facilities and access to the central bank balance sheet. but it's an important question, and of course, were such facilities to be opened up, it must involve commensurate regulation and supervision of stablecoin issuers. I'll just note that another method to prevent the risk of runs, rather than lender of last resort facilities, would be to require stablecoin issuers, or at least the systemic ones, to hold reserves exclusively at the central bank. And there are some jurisdictions that seem interested in this approach, but thus far the regulatory regimes have not gone in that direction, notably the US regime. So in general, when we're thinking about stablecoins, we think the guiding principle should be same activity, same risk, same potential for facilitating tax evasion and illegal acts, same regulatory outcome. The precise method of regulating will not necessarily be the same as in the traditional financial sector. The blockchain is a different beast, but stablecoins should not have an advantage over other payment methods simply because they can skirt existing regulations. Okay, with my time left, I just want to touch briefly on alternatives to stablecoins because stablecoins are, of course, not the only option for bringing the monetary system into the digital age. Innovation could occur within the two-tier system by central banks and commercial banks. So central bank digital currencies could serve as a new form of digital money. CBDCs could bring new functionality, as well as reaffirm the role of public money, reaffirm that anchor as cash use declines. And so-called retail CBDCs would provide digital cash that's a liability of the central bank to households and businesses. So, to date, stablecoins have definitely gotten a head start over CBDCs, and some view CBDCs as likely to lose out to stablecoins because the latter carry fewer regulations and restrictions today, right? But as Ken was mentioning, this misses the point that ultimately, in a world where stablecoins no longer benefit from this regulatory arbitrage, if we get there, stablecoins and CBDCs would need to be governed fairly similarly, in which case it's not at all clear that retail CBDCs will lose out in the long run. And while retail CBDCs get most of the attention, particularly in the political discussion, innovation on the wholesale side for interbank settlement is critical as well. I won't dwell on this here, but settlement of large value transactions in central bank money is important, and wholesale CBDCs could help ensure that such transactions continue to be settled in central bank money. Now, to be clear, CBDCs come with their own set of risks and hurdles that they'll need to overcome, which help explain why rollout has been slow. So, just as with stablecoins, actually potentially even more so, CBDCs could disintermediate the banking sector. The design choices are very complex and the stakes are high as the financial system depends on central bank operations running smoothly every single day. This isn't something that central banks can roll out and kind of just get wrong because that's going to have serious ramifications. There are also intense privacy concerns since central banks could have access to consumer data, and the politics behind CBDCs, as we've seen here in the United States at least, can become very heated. So these are all complex issues to be sure, but they're not unsolvable. We think countries will go down different paths, but central banks need to ramp up work in this area because ceding the digital currency ground entirely to private actors, particularly non-banks, poses serious risks. Okay, so just to briefly wrap up, this moment in monetary history might seem unprecedented, but the history of money is a history of transformation. The technologies are different, but the fundamental issues remain the same. And it's imperative that the public conversation stay centered on this principal issue of how to make money safe and trusted. Stablecoins have the potential to bring new functionality to money, but the regulatory gaps must be addressed. And central bank digital currencies can also bring money into a new age, and they can do so from within the two-tier system, helping to reaffirm that anchor. So with that, I look forward to your questions, and I'll hand it over to Melissa.
Our first question is, you compare stable coins to the free banking era, but after the Genius Act, isn't a more apt comparison the national banking system in the late 19th century?
Please, Max, go. Max wrote a prize thesis on the financial history of that period, so he is well equipped to answer this question.
Thanks. So that's a very interesting question. So, in the report and in the presentation today, we argued that the free banking era, which is basically from 1837 to 1863, the decades leading up to the Civil War, is the best comparison for stablecoins. But after the Genius Act, some have suggested that the national banking system, which took place after the Civil War up to the founding of the Federal Reserve in 1913, might be a better comparison. So under this national banking system, banks that were part of it issued their own notes. So they issued their own private notes, but they were regulated and they circulated at par. They didn't have the discounts that the free banking era had in the earlier decades. So I think the notion is that stablecoins are now kind of under the regulatory tent with the Genius Act, and they have restrictions on reserves that make them somewhat comparable to the notes issued under the national banking system. Stablecoins will have to hold high quality liquid assets. Under the national banking system, the banks had to hold treasury debt as collateral. So the reserve, even though they actually had to over collateralize, but that's just a minor point. And so the similarity in reserves kind of could just make people think that the national banking system's a better comparison. But I think that it kind of misses more of the differences in the two systems. So and makes a free banking era still more apt. And I think the key thing is that money isn't just about the reserves backing it. Okay, as we make clear in the report, it's about the entire legal, regulatory, and supervisory structure supporting money. And so there are some like very big differences between the free banking era and the national banking system. One of the big thing is that national banks didn't just collateralize their notes. Okay, they also had to contribute to a redemption fund at the Treasury. I think it was about 5% of their notes in cash, and then the Treasury guaranteed that it would use this fund to redeem any national banknote. And in fact, the Treasury didn't just say we'll only redeem national banknotes up to this 5% that any bank contributed. They promised to redeem in cash any national banknote. So fundamentally, the US government, the Treasury, was standing behind the national bank note circulation. And so, the full faith and credit of the US government was actually underpinning the entire circulation of these currencies, of these notes. I think one or two more differences that are important is that when a national bank failed, the holder of a note had the right to instant redemption of that note in cash immediately. That's not the case with stablecoins. There's a bankruptcy process. The Genius Act has some ways of expediting the process, but there's still this gap in time that could be problematic. And also under the national bank system, notes, any holder had the right in general, not just when the bank failed, to instant redemption at par or immediate redemption at par. Again, that's not the case under the Genius Act, where the Act doesn't specify any rules about redemption policies. It just tells issuers to be transparent, so they could charge different fees. It might not be immediate. So there are more differences too, which I won't get into. But I think for all these reasons, there's a much greater government effort and standing behind the national bank note circulation, which helped guarantee that they circulated at par, which is not the case with stable coins. And so I think the free banking era remains the better comparison. But as mentioned, again, we know it's 200 years earlier, technology has changed. We don't think we're going to see the same constant massive discounts on notes all the time. It'll be easier to transact because you have these real-time markets, but it's still that key deviation from par, which is what matters.
Thank you, Max. Our second question is, many argue the growth of crypto treasury companies, including those holding stablecoins, threaten the market for U.S. treasuries and other government debt. However, the administration argues that boosting stablecoins increases the demand for U.S. Treasuries. What are your thoughts?
Well, that's been written about a lot. I think it very plausible, the claim that the demand for stablecoins will uh, grow by a factor of tenfold, or something eightfold, tenfold, as some have argued, and that'll increase the demand for treasuries by up to 10%, and so in principle give a lower interest rate. However, some of that will come out of existing money market funds, disintermediating deposits. So it's hard to know what the numbers are, but I'm not sure that we'll get a net increase in demand. Also, as Max carefully said, uh, they're not all backed by treasury bills. They're backed often by bank accounts, which are subsidized in a way by the treasury, but they're not backed by the treasury bills. So there's certainly some benefit there. But on the other hand, as we've stressed, and I think again, the comparison to $100 bills, or here $10,000 bills is maybe the comparison, is it penny wise and pound foolish? How much interest are you saving? Look at the numbers for tax evasion, which the IRS estimates to be easily $1 trillion a year, and ask yourself, how much are you saving on interest if that grows by 10 or 20%? So again, these things aren't not fixable, but there's certainly a sense in which these crypto and stablecoin acts were kind of rushed out the door, I suppose, to repay debts both parties got in the election. And they do move things along, but we argue there are ways in which it's really too fast and maybe thoughtless.
Thank you. We have a third question. I'm actually putting together two questions that are related. Transitioning from stable coins to central bank digital currency. Nicoletta Mosher from the European Stability Mechanism asks whether these two can be complementary means of payment and under which conditions. Additionally, Haruhiko Kuroda, former governor of the Bank of Japan, asks whether CBDCs will replace demand deposits of commercial banks and change the settlement system.
Max, you want to take a first stab at that?
Sure. I think, you know, I think there's certainly scenarios where CBDCs and stablecoins can coexist. I mean, as we've discussed in the report and the presentation, the two-tier system is kind of predicated on public and private money coexisting. Now, there's a intricate connection that makes it work, and that stablecoins, as currently constructed, can threaten. But with some of the recommendations we make, stablecoins might be able to fit better into it. And then you have different use cases for different, digital currencies. CBDCs could kind of continue to provide that anchor of public money and an outside option. So there's always this perfectly riskless form of money that people can use. And then stable coins, if the innovation is really there and they have other use cases, there's certainly a case where they could coexist. And I'll just also add that, yeah, I mean, I think a big concern with CBDCs is this disintermediation risk. Because again, it's public money, so it's perfectly riskless. And it could be easy to transfer your deposits into your CBDCs. But I think, central bankers are very aware of this. And one way you can deal with it is simply, at least at the beginning, to have, maximum set limits on how much you can hold in CBDCs or how much you can be moving from your bank deposits at any given time to try to prevent massive disintermediation.
I'll just add to that. I get to talk to many super smart scholars on both the left and also very smart analysts that I would describe as on the right. And I want to say the kind of far left and far right, to be clear. And it's amazing how this brings them together. They both recognize that there could be massive disintermediation of the banks, but they both like that. Many of the scholars on the left just don't like banks and, would like to have a very different system. Many on the right, I don't know if it's they like their investments in Bitcoin or that they don't like banks, but they're also, say, look at the credit card fees that banks charge. Look at all the problems we have. Look at the vulnerabilities. Let's get rid of them. I think people in the center, call it the center left and the center right and the center, are more cautious about that, where we've had this system, it's worked for a long time, it's risky to make a rapid transition. And there's certainly a tension there between the creativity of, I'll say, the far left and the far right and pushing this ahead faster and the caution. And admittedly, our group represents the caution more, but we think the caution, a careful look, suggests it's quite warranted.
Thank you. Our next question is from Geeta Gopinath at Harvard. Why are stablecoins worse than uninsured deposits at banks? Why do we worry less about singleness with uninsured deposits?
Well, Geeta, you could have just walked across the hall to ask that, but you might be in another country right now. Um, So, clearly they're closely related. We have, as far as I can see, we live in this, financial welfare state where the net around the financial sector grows and grows and grows, and we don't seem to be able to draw a line around it. And we're going to see something parallel here with stablecoins, where we're going to have bankruptcies. We're going to see what they bail out, what they don't bail out. It'll have a lot of systemic effects. But yeah, I mean, I'd absolutely, it's a good point that the existing system has implicit insurance. I mean, that said, we have a lot of experience with it. There are things we wish we should have done differently, but I mean, the concerns that this will clearly stable coins, we will have blowups. It really seems to me it's designed that way in order to consolidate the market, which I think is where it's going to end up.
Thank you. We have a question from James Chong at Sing Life. Given the accelerating experimentation with central bank digital currencies by major economies, how should policymakers balance the potential benefits of digital efficiency and inclusion with the systemic risks of deposit flight and disintermediation in traditional banking?
Max, you want to try that, or would you like me to answer?
I mean, I think this is one of the big questions is how to handle disintermediation. I think we've kind of touched on it that with different, with CBDCs, you can set limits. Also with stable coins, there's some discussion of setting, beginning limits on how much you can hold in stable coins. But I don't know, Ken, you might have.
Well, I mean, the United States is much better able to handle disintermediation than I think a lot of the world is. We have a less bank-centric system. We have a much more creative financial system. So to the extent experimentation with disintermediation is taking place, the United States can handle it. We have things like rocket home loans and stuff. We have a lot of loans being done outside the banking system. That said, there are certainly many kinds of borrowers who are not serviced that way. They're too small, they're too heterogeneous. And absolutely, the reason central bank digital currencies haven't moved faster, the number one concern has been disintermediation. Okay, great. There are other ways to do payments. What do we do about lending? And we've seen what happens in financial crises when we impair the lending system for long periods.
Thank you. Another question is, will dollar stablecoins further entrench the global role of the dollar?
Um, did you want to go, Ken?
Yeah, I mean, that's certainly the idea. There's, I think the dollar dominance probably peaked 10 years ago and has been fading. And there are many, many reasons that it's going to become weaker. Number one being that China needs to move away to develop its own back office, to develop its own ways of doing international trade. And stablecoins, particularly operating in Africa, Latin America, are conceivably something that will get in the way. So I'd say from the point of view of trying to preserve dollar dominance, which is probably on the decline for many reasons, it's a strong move to push back in the other direction. That said, if it blows up our own financial system, it might not look so good.
Yeah, I completely agree. And I guess I would just also add that, the United States isn't doing this in isolation. Other countries are responding. And I think the stablecoin push has really, concerned other countries about all the risks that we discussed about monetary sovereignty and tax evasion. And so you might see, Europe has really kicked up its stepped up its work on the digital euro. And you could envision a world where, if stablecoins are blowing up everywhere, and then you have a digital euro that's safe, it could actually increase the euro's international role and maybe eventually kind of undercut the dollars.
Thank you very much to both of you. Unfortunately, we've run out of time for more questions. Please join thanking our webinar speakers. We would all like to thank all of you for taking the time to join us today.
Thank you.